Has anyone wondered about the current state of the Chinese stock market and how public mutual funds have played a role in shaping it? The answer might surprise you. In the early days of January 2024, the Chinese stock market experienced increased volatility. As of January 9th, the primary indices of A-shares have seen a decline ranging from 3 to 10%. One of the main reasons for this is the redemption pressure faced by public mutual funds, leading them to reduce their positions. These public mutual funds hold about 8% of the total circulating market value of A-shares. For a long time, fund managers have had a tendency for convergent trading, either chasing the same stocks simultaneously, causing their prices to skyrocket far beyond their value, or selling off the same stocks at the same time, leading to a significant drop in their prices. The outcome? The market and its investors bear the brunt. Imagine if you bought 1,000 shares of the top 20 stocks held by public mutual funds on various dates. If you did that on September 30th, 2020, by January 9th this year, your floating loss would be around 298,000 yuan, with an investment yield of negative 8.82%. If you did the same on the same date in 2021, your floating loss would be 1,519,300 yuan, with an investment yield of negative 31.71%. If you did it in 2022, your floating loss would be 929,800 yuan, with an investment yield of negative 20.91%. Finally, if you did it in 2023, your floating loss would be 570,700 yuan, with an investment yield of negative 13.21%. In all the time frames mentioned, the performance of these 20 stocks heavily held by public mutual funds was worse than the Shanghai Composite Index. Specifically, from the beginning of October 2021, these stocks lagged by 12.8%. From October 2022, they lagged by 16.57%, and from October 2023, they lagged by 6.23%. The performance of these heavily held stocks is largely due to the criticized investment style of public mutual funds. However, objectively speaking, the formation of this investment style is largely related to the quality of A-share listed companies in the market, which severely lacks high-quality targets. Overall, the performance of active equity funds, mainly ordinary stock funds and mixed equity funds, is also dismal. According to data from East Money Choice, the total returns created for holders by active mixed equity funds in the first 3 quarters of 2023 was negative 3,622 billion yuan, and in 2022 it was negative 9,698 billion yuan. In the same period, the management fees charged were 26 billion yuan and 54 billion and 500 million yuan respectively. Whether it's the impact of group trading and trampling style adjustments on the market, or the terrible investment experience of fund holders, the credibility of public mutual funds is in a certain crisis. Whether this crisis will be alleviated or continue to intensify in the future, we'll have to wait and see. So, the role of public mutual funds in the Chinese stock market? It's a complex one, with a significant influence on market volatility and investor returns. Yet it's also a role that's under scrutiny, with the potential to evolve as the market matures. This is the story of how public mutual funds have influenced the Chinese stock market, and it's a narrative that's still being written.